Hey, Froshies, sell me these sensors.
We're not business people.
You are now.
Woo! Bring 'em out, bring 'em out, bring 'em out, bring 'em out. It's hard to yell when the barrel's in your mouth.
Come on.
Bring 'em out, bring 'em out.
Hey.
Bring 'em out, bring 'em out.
Yeah.
Bring 'em out, bring 'em out.
Hey.
Bring 'em out, bring 'em out.
VIP coming live from the VIP. Heard the nightlife, lost life without me. Most feds in the state wanna see by me. The whole city got pissed, heard he got 3. That other nigga got a hip and shouted he not out. Who set the city on fire soon as he got free? The king back now, hold don't even know how to act now. Hit the club, strippers getting naked before I sat down. Still ballin', money stacked tall in shack now. Still push a button and let the roof on the lag down. I'm on the road doing shows, put my Mac down. Mississippi to Philly, Albuquerque to Chat Town. I got the crowd yelling,
Bring 'em out, bring 'em out.
hey, all my hot girls yelling,
Bring 'em out, bring 'em
hey,
out.
all the dope boys yelling,
Bring 'em out, bring 'em
hey,
out.
front to back they yelling,
Bring 'em out, bring 'em out.
Get with other rap nigga hooded than this. I got rich and I'm still on some hooligan shit. You be rapping by blow, I don't move in the shit.
As our team began its journey through the Capsim simulation, we experienced many successes and failures. At the beginning of the simulation in round 1, we were able to pull ahead from the other competitors and claim first place overall with a 99.6 final score relative. With 27% of the market share in high-tech and 14% in low-tech, we felt that we continued to follow our strategy and make adjustments along the way if needed. We remained first overall through rounds 1 through 4. However, in round 6 we were surpassed by Chester and later by Digby, bringing us to an ending result of 4th overall. From a financial standpoint, we were able to bring Erie Industries from a poorly managed company to one that now holds a AA credit rating, has $64.6 million in accumulated profit, and a company that has a well-planned and thought-out business strategy for the future. Despite not coming first overall and generating the most profitable company, we held the second highest return on sales, third highest return on assets, and working capital. This illustrates that while we did not make as much of a profit as compared to other companies, we are still very profitable and are a healthy company that can be handed off to you. Erie Corporation finished with a stock price of $63.84, cumulative profit of $64 million, and a total market share of 18.46%. In order to finance our company in the beginning rounds, we issued long-term debt to fund our 5 different products: E, Elmo, eSig, EL, and Ebola. By doing this, we were able to spend the debt to advance TQM and reduce costs. By the end of the 8th year, we maxed out our TQM and were operating with 11.8% reduction in material costs, 14% reduction in labor costs, 40% reduced R&D cycle time, 60% reduction in admin costs, and a 14.4% demand increase. Through investing into the TQM, we reduced the majority of our costs and were able to increase demand for our 5 different products.
Let's look at the industry forecast. Here in round 1, it's all sunny skies here with industry. Erie is looking fantastic and the weather is beautiful. Round 2, a chance of high market share and excellent sunshine, leading us into round 3 with even more sunshine. Erie is climbing the charts. In round 4, there's heavy cloud coming here, and the weather is heating up. We might see some rain here in round 5. Round 5, Chester is looking great, and the temperature is heating up even. And in round 6, Baldwin is sneaking up from behind, and the temperatures are continuing to rise. In round 8, Digby crushes the entire industry, and the temperature drops to 20 degrees Fahrenheit.
Our company adopted a product differentiator strategy, launching our products in the high-tech segment, allowing them to drift to low-tech over time. This allowed our company to have the most market share overall through the 8 years of operating. To keep our research and development costs low, we had low automation for the majority of our rounds. We set our prices high in order to maximize profits. This was effective because of our initial focus on customer size and performance preferences. During rounds 2 and 3, we used accumulated profits to increase capacity, develop new products, and increase training hours. This allowed us to dominate the market share early on. Moving on to rounds 4 and 6, we continued to develop new products in high-tech. Additionally, we began investing in total quality management and updating old products as they started to become outdated. In our final 2 rounds, we continued to update old products and lowered R&D costs by increasing automation. Although our market share began to decrease, we recognized the importance of focusing on keeping strong products in both low-tech and high-tech segments.
Today we will be discussing Erie's 5 products. Firstly, each product was introduced in the high-tech segment, after which every product introduced after that was leapfrogged into the higher-tech segment as the older products drifted into the low-tech. For each product, we focused on the performance and size criteria that each customer would like. Next, every product was focused on long-term profitability to ensure that customers were always satisfied with Erie's products. With our low R&D costs in the last 3 rounds, we were able to minimize our material costs and ensure that our costs were lower than all of our competitors, reaching us closer to the top. All 5 products began in the high-tech and drifted towards low-tech, which explains why our low-tech market share reached 20% by round 8, and our high-tech market share was 20%.
Due to our product differentiator strategy, we could afford to keep our prices elevated to cover costs, while still having attractive products. This allowed us to maintain strong margins. We realized that by following this approach, we were still losing customers in the low-tech, as price was very important to them. We therefore tried to lower our costs as much as we could, while still making a profit. Our promotion budget, which focused on advertising and public relations, averaged at a cost between $1,200 and $1,500,000 per product. These numbers were held to the low side for the low-tech market, for once they reached that segment, they had already been on the market for a few years and needed less promotion. By the end of the 8th round, we had managed to have an accessibility of 100% for all products other than EAT, as we decided not to produce any that year. Our sales budget, which focused on funding salespeople and the distribution systems to the customers, was approached in the same manner. We managed to attain 86% in the low-tech and reached 100% in the high-tech segment, which followed our initial strategy.
Team Erie had some issues with forecasting. Our strategy included beginning with the market share percent from the previous year and then comparing it to the new percentage for the current year. Our team had problems with stocking out, which was unfortunately only effectively fixed in the last round. For the later rounds, although we would stock out, we were equivalent with our potential market share and became better at forecasting. When it came to production, our intention was to be cautious not to overproduce. At the beginning of the simulation, we focused a lot on how much capacity was needed. However, as the project progressed, we decided to rely more on the second shift to keep up with demand. The amount of products we produced was influenced by our predicted margins. We made it a priority to keep all margins above 30%. This caused us to have to raise the price of our products as well as lower our production. Towards the final rounds, we decided to increase automation, however, only to an average level of 4. This was because at the later time we realized the cost of increasing automation outweighed the decrease in material costs that it would have resulted in. Towards the end of the simulation, our focus drifted away from buying capacity. This affected Team Erie towards the end as we weren't able to produce as much as our forecast allowed us to, which led us to maximize the capacity of our second shift. For HR, we invested in an average of $100,000 in recruiting spends. We also decided to have an average of 60 training hours. This resulted in us having very high employee satisfaction and minimal separated employees throughout the simulation.
From a financial perspective, our initial strategy was issuing lots of stock at the beginning of the simulation in order to finance our business. This stock was meant to fund our projects, R&D, and to have enough cash to control future and potential risks. We also wanted to maintain a steadily increasing share price year over year. Therefore, we did not pay dividends until the last 2 years, so we could keep our cash and boost the share price in the last 2 rounds. As the simulation progressed, we issued lots of long-term debt to leverage ourselves and not dilute our EPS too much. More debt does mean higher risk, but it also means a higher potential reward. Our team's stock price was near the top until year 6, when, as can be seen on this chart, Andrews used high dividends to boost ahead of us in the year 2020. We issued the 3rd most amount of common shares and had the 2nd highest market capitalization. Our earnings per share was pretty high and possibly a little too high. We could have used more debt to balance ourselves out, as our debt-to-equity ratio is only 0.422. We issued 2 dividends in the last 2 rounds of the simulation because of an excess in cash. We were not producing any more products, only upgrading them, which took little capital. We also wanted to boost our stock price and make our shareholders very happy. Our dividend yield was higher than industry averages, although lower than other teams, such as Ferris and Baldwin, but their dividend yields were actually very large, possibly even unstable. We had 6 bonds issued over the course of the simulation. and they all had AA ratings for most of the simulation. We never had any junk bonds, which we're very happy with. Our original strategy in total quality management was to wait a few rounds for our cash balance to increase, then input money to reduce costs and increase our product demand. These costs helped our company improve our contribution margins and financial statements in the long run, as material and variable costs fell as we had put a lot of money in every round in the last 3 quarters of the simulation. By the end of the simulation, we maxed out all of our TQM categories without experiencing any diminishing returns.
Team Erie had many highlights and notable moments, as seen in the graphs behind us. First off, the highest market share occurred in round 5, with 21.3% of the market. Next, in round 1, we had the highest comparative stock price at $23.91 per share. And finally, our best final reports included 743 cumulative points in round 1.
We have recommendations for you. Focus on improving the financial structure of the company through paying off long-term debt. By doing this, Erie Industries will have higher retained earnings and will be able to keep more profit by not having to pay interest every year. Focus on the high-tech segment. It is growing at a rate of 19%, therefore offering more opportunity to make capital. This can be done by reintroducing EAT as a high-tech product and having a total of 3 products in the high-tech segment and 2 in the low-tech segment. Focus on improving our ROS and ROA. Having the highest market share does not guarantee the most success. By increasing efficiency in these areas, we will increase overall profit.
Lastly, you cannot look only to the perceptual map when determining the attractiveness of your product. You need to keep the price, age, and mean time before failure into consideration as well. This is especially important in the low-tech, as price is a large factor in customer decision-making.
Woo! Bring 'em out, bring 'em out, bring 'em out, bring 'em out.